Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Raymond Bridges, Portfolio Manager of the Bridges Capital Tactical ETF, to discuss how markets are responding to Jackson Hole and the implications to interest rate policy. Raymond, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. I want to thank you for having me back on. Since the last time I was on, we launched our ETF in May of this year, and we saw, some decent success. We saw AUM increase by roughly 50% and net asset value grow in the ETF by roughly 3% with very low volatility. It's been really good.
Yeah, well, congratulations on those numbers. Let's talk about Jackson Hole. What were your thoughts following Powell's speech, and do you think the markets are responding accordingly?
Yeah, so I would say post the theme of the speech was overall congratulatory on the success the Fed has had so far stemming the pace of inflation. He focused on three areas of inflation. He sees core, also known as headline inflation, along with housing services inflation as both being good and moving in the right direction. He did break out the non-housing services part of inflation as moving sideways. He stated that it's dependent on labor market strength. This is where he stated that the economy would require below trend growth and or softening in the labor market to bring this element of inflation back in line. Powell stated that above trend growth could warrant further monetary policy tightening. Now, with this in mind, I want to remind your viewers that the Fed does have what is often referred to as the dual mandate. This encompasses both a focus on stable prices, which would include inflation, and maximum employment, which speaks to the labor market. Powell, no matter what your viewer's opinion of success or his personality or what the role of the Fed should be, one must admit that he is acutely aware of this dual mandate. Now, with that in mind, along with his Jackson Hole speech, where he stated that non-housing services will require either below trend growth and or softening of the labor market, I do believe Powell has the cover with a currently strong labor market to focus on that stable prices side of the mandate even further, perhaps even overshoot it a little bit to give confidence that the 2% target will be maintained.
Right. And of course, he doesn't want to shift strategy too quickly either. So what are your expectations in terms of interest rates, perhaps pause and another raise here? I mean, it doesn't sound like they're going to be cutting, certainly, not the first quarter into 2024.
Yeah, so I would say it with that congratulatory theme of his speech and his rhetoric going forward from the last FOMC meeting, that uncertainty as to next policy action is going to be what he's putting forward. He's really trying to focus on data dependency, which is different than the previous hikes throughout this hiking cycle, where he sort of forecasted and let the market know what the next policy action would be at the presser following the FOMC meeting. This time he's doing uncertainty. You probably heard the quote that's been getting a lot of traction from his Jackson Hole, where he's navigating by the stars on a cloudy night. And this created nice imagery of that uncertainty, but also gives him that cloud cover in case he does create some labor market weakness and forces that below trend growth to go. So I would say there is a good chance for an additional pause with that uncertainty, but it doesn't change my overall forecast for equity prices over the next 6 to 9 months.
So when you think about tactically positioning over the next 6 to 9 months, how are you managing that?
Okay, so what we're looking at, we did have some good success over the last 3 to 4 months since the launch of the ETF, where we were scaling off into this position, but there's a couple real things that are giving pause. So this higher for longer mantra that the Fed has is there's a real economy out there that's being affected, along with this bank term funding program that continues to be accessed by these regional banks. It was about 375 million just last week, 787 million the week before. The small banks continue to access that bank term funding program instead of the discount window. It's expensive. It's a fixed term for a year, and they have up until March of 2024 to continue to access that. They've accessed it to the tune of 5.6 billion since the last week in June. So regional banks aren't in the strongest position right now. And you can look at like the KRE index; it's in a downtrend, and it's it's kind of done a little bit of a bear flag on the chart. But we've broken to the downside of that bear flag just last week.
All right, Raymond, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me. It was a pleasure.